The following is a presentation of TFNN. Trade what you see with Larry Pesavento. Call now, toll free at 1-877-927-6648 or internationally at 727-873-7618. Now, Larry Pesavento.
Okay, looking good, Billy Ray, feeling good, Lewis. Well, the one thing we know for sure, and that is when this stock market started up Sunday, there was not going to be much in its way. And I sent out a video to that effect around 11 o'clock Sunday morning, because after looking at the charts, if we went above 3,400, it was almost a foregone conclusion we were going to hit 3,425, which was the 1.618 expansion on the S&P, and I believe the NASDAQ is now at the first standard deviation that we talked about in the newsletter. So we're going to be having interesting markets here. I posted the DAX, I posted the FTSE. You can see the DAX has had a tremendous move after the big ABCD down. It was up about 2%. FTSE was a little bit behind it, but still moving up. So we're going to have a really good market. You know, folks, I look at charts all the time, and you know, sometimes I'm right and sometimes I'm wrong, but I would like to bring to your attention something that is very, very close to me as far as looking at markets, and that is the chart of Apple. And we're going to bring this up right now and discuss it here just a little bit. Bill Meridian will be our guest here at the break at 9:17. He's got some really great slides, so I'm sure we'll enjoy that. But here is the chart of Apple on the daily. I would like for you to pay attention to this because I believe it's very, very important. We are looking at a speculative blow-off in something, folks. I don't know how high it's going to go. My work said it was going to go to 509 today, and I believe we've hit 512. But what we're looking at here is to pay attention to at the stock at $400 a share. Notice how it gapped above the 1.618. That was really important, and we did talk about that. Then it gapped again the next day. We've had 1, 2, 3, 4. Today it will be 5 unfilled gaps. Well, who knows? But we have 5 unfilled gaps. I don't care where you go on this Apple chart. You're not going to see an unfilled gap. So this is a speculative blow-off. The question is, how high can it go? And that's basically what I'm watching here. So all I can tell you is I don't know when this is going to be over, but it will fill that gap at 400. That's down 20% from where we are right now. So that's neither here nor there, but if you can find a gap on Apple that hasn't been filled, please send me the information because I would like to see it. Also, the Treasury bonds, we got up to that real critical level at it hit actually 179.31, I believe. That critical level, of course, was 179.26. I think the bonds are in some type of a trouble. We'll be able to see. They're asking about the split. I believe the split is tomorrow. I think Tommy told me that 8:31. That'll be next Monday then. Thank you very much, Jimmy. Jimmy's right on top of this. So Apple splits 4 for 1. Right now, I believe it splits about 127 or something like that, up 27% from the split level. But the most important thing about Apple, and the reason why I wanted to bring this up, it made the front page of Barron's, folks. And when that happens, you got to be careful because it has the uncanny ability to pick tops and bottoms like you've not seen before. All I'm looking at, folks, is this straight up move that we're watching now. Trading it, from today, what I'll be watching is I'll be watching that 512 level, and I don't trade Apple, folks, but I watch that because it's so much of an indicator for the stock market that it's incredible. Look what it is. It's in the Dow Jones Industrial Average. It's trading for, the highest level of anything in the Dow, so it's heavily weighted because in the Dow it's price weighted. It's cap weighted in the NASDAQ, and between Microsoft and we've got a Microsoft and Apple, we've got nearly 25% just in those two stocks. And it looks like Tesla is going to have a 5-to-1 split. Okay, that's good. So we'll see how these things work out. But All I'm looking at here is what happens with the swings. And as far as the Bradley, I have to assume that this thing is off. It should have topped on the 19th. We're 5 days out. It could possibly turn today, but the odds of that, are relatively slim, I would think. But in 2009, I'll bring that up because it was very interesting. This was a big move for me. Let me move this up here, and we'll take a look at this. If you'll look at this chart here, if you'll look at it, very closely at the bottom there, you'll see that there was a double bottom there between March 5th and March 9th. That was a 5-day window before that thing took off. So just wait and see what it does. All I knew that if it opened up Sunday night, I knew that, I didn't know, but I assumed that we were going to be up to make at least that expansion on the S&P up to the level of 34.25. That's a key level. Getting above that, there's nothing but blue sky. So we'll be watching that very closely here this morning. Okay, now I wanted to bring to your attention one other thing, and that's the banking index here, because even though the rest of the market has been really strong, if you take a look at this banking index where the real money is, you'll notice it's been lagging the market quite a bit. 2 weeks ago, 9 days ago, we made a high at the 61% retracement at that 83 level. We're trading at 74 right now. Any move below 72 would signal this thing has a possibility of really going down. You'll notice the bottom. Hold on here. I think we have a question coming in from somebody, and we'll see what's going on. And Marshall is asking me a question. Don't know the answer to that question. Marshall is asking, where will be the high in the stock market today? And I don't know the answer to that, Marshall, but I get your drift, my friend. And thank you for the lovely gift that you sent. I appreciate it very much. It brought a lot of memories back to me. Okay. Okay, that's basically it with the dollar. The dollar index is the next one, folks. I believe that dollar index has turned. We're getting a little bit of a rally in the euro right now. It's at a very, very critical level. If you're looking to short it at this 118.40 level, you don't have to risk much here. There's a double number up in that area that could give it a little bit of trouble. So we'll see if that's going to be the case. Someone's asked a question about the importance of the 34.25 level. Folks, it's a 1.618 expansion on the daily range. That's a really a big deal. So you got to pay very close attention to that. And also, we're right now at these levels. When your Dow Jones is up 300 points on the day like this, you're basically looking at one standard deviation in these moves, right off the bat. So you've got to pay close attention, to those numbers. So that's the real key to watching these, in my opinion. Someone's asked a question. We've got a break coming up already, but we've got a question about the natural gas. It just continues to go higher, folks. We've been very bullish this. We waited for a pullback to see if we could, get back in it. But so far, that has not happened. And you'll notice here that we are now going sharply above the highs of Friday. We'll be right back. 877-927-6648. Stay tuned for Bill Meridian.
If you're not currently using the TAS Profile Scanner when looking at setting up your trading opportunities, then your arsenal is short a mighty weapon. The TAS Profile Scanner is a standalone piece of software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Headed by Steve Dahl, TAS understands that in today's technological world, the use of top-flight software applications and technical analysis expertise is essential to successful trading in today's market. You also gain access to the webinar that Steve Dahl and Tom O'Brien just hosted, The Best Way to Use the TAS Profile Scanner to Profit. This webinar archive is available for all subscribers immediately upon signing up. All new subscriptions also come with a 30-day money-back guarantee, so you have nothing to risk. Start your subscription by visiting the front page of TFNN.com today, and you'll find the TAS Profile Scanner under the Services tab. Sign up today. Are you in the market for buying or selling real estate in the Bay Area, including the surrounding St. Petersburg, Tampa, and Clearwater markets? Tiger Real Estate LLC is a firm that has extensive experience in the Tampa Bay area. Whether you're looking to sell your current property for maximum value, or you're in the market for a second home or investment property, Tiger Realty has the experience across all areas of real estate in the Tampa Bay area to help buyers and sellers make the most informed decisions across all price levels. From the price you should be paying per square foot in certain up-and-coming areas to the type of cash flow investment properties are capable of creating, Tiger Real Estate can help you make the best decision when it comes to all areas of the market. Before you make one of the biggest decisions of your financial future, call Tiger Real Estate LLC today at 727-329-8322 or email us at tiger@tfnn.com. That's 727-329-8322. Call us today.
Many of our new listeners have heard about The Tiger's Den. The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of the TFNN shows, plus see all of the charts as they happen live and have access to archives of all of those charts. You can test drive The Tiger's Den absolutely free for 30 days and greatly enrich your knowledge of these markets and how to make your money work for you. Details on The Tiger's Den are on the front page of TFNN.com.
TFNN has launched our brand new website. You can still visit us at the same TFNN.com URL, but when you do, you'll see a new and improved homepage with a much simpler navigation, whether you're watching Tiger TV live in high definition or just accessing your newsletter subscriptions. We even have new pricing in 6 months and yearly options. Check out the new TFNN.com now and experience all the upgrades. TFNN.com, educating investors.
Call now, toll free at 1-877-927-6648. Internationally at 727-873-7618.
Okay, we're back, folks, and I believe we have Bill Meridian from Cycles Research on the air. Bill, are you there?
Good morning, Larry.
Good morning to you, my friend. Everything okay?
Great, yeah.
Good. Well, you've given us some great information, and I'd like to start off. I guess I've put the announcements and everything in there for you, so we'll start out with chart number 3. How does that sound?
Okay, so you already went through 1 and 2.
Yes. Yeah, if you want to cover that, yeah, we're on 3. I thought, because these were announcements and we could cover that easy. You've got some nice slides here, and I want to make sure we have enough time because,
sure.
Go ahead. We're on number 3 then, so why don't you go ahead
the main points, gold correction, I think ends this week. By the end of the week, I think gold will resume its uptrend. The S&P is likely to correct in September. It is probably, as I said, as soon as the market bottomed in March, started rising, I said out in front of us, I think there's only 1 weak month, and that's September. But I think that'll be a shallow correction. Bonds defied the cycles, did not do what I thought they would do. We'll cover that. They'll rally, I think, from here into September before falling again. So let's go down. I don't know if I presented this last time, but it's such a great graph. It shows the MSCI world return as the light blue line and the global real M1 supply with a 10-month lead. And you can see that due to the coronavirus, the money supply is shot straight up. The only response they seem to learn at university and in government is to simply print more money whenever there's a crisis. Although, of course, the money is not going to prevent the virus. It only, as Ludwig von Mises would teach us, cheapens every unit of purchasing power already in existence. And now we'll move to the next slide. And there's an old saying in New York that cocaine is nature's way of telling you have too much money. Well, here's nature's way. This is from the collectibles market of telling you the whole society has too much money. There on the left, we have a 1948 Monaco Grand Prix poster going for $10,000 to $15,000. In the middle, we have a Grand Prix 1957 from Monaco, 10 to 15 grand. And here we have, if you want to save money for 8 to 10 grand, you have another poster from 54. And if you go down one, this is a pair of basketball shoes actually worn by Michael Jordan, Air Jordan 1 model. With 23 minutes to go, the bid was $500,000. So there is so much money, everybody has enough money to buy everything. So let's go down one more. And of course, one of the things they have been buying this year has been gold. After, let's see, that bear market, let's see, started 2011, was about, 7 or 8 years long. And it didn't really fall that much. But here you see the gold seasonality for the last 51 years. Now remember, this is expected return. So it is the probability which gold is going to go up, which in August is 60% and in September is 61%, multiplied times the amount it actually went up. So it went up about 2% in September, and there's a 61% chance of it going up. You take the product and you come up with approximately 1.0, which you see on the graph. So as you can see, the best time to own gold has been between June and September. So September is right in front of us. These are, as I like to say to everyone when I speak, these are static cycles. They do not change much year to year. And for that reason, you also have to take it a step further and look at the static cycles, which are on the next page. These cycles are drawn from the most recent price data. On the top, you see the weekly cycle. On the bottom, you see the monthly cycle. And you notice that gold came down with the monthly cycle, but it didn't even, at the moment, it's actually above the sell point. So, in other words, the sell signal didn't really affect it that much. That's how strong the underlying trend is. And there you see the green line just short of September 1st. That's about the last day of this month, which is the last day of this week. The weekly cycle, I have to discount it, is not going to overpower the monthly cycle. So we have both the seasonality and the monthly cycle pointing up as of the end of this week. And you remember last time I was on, I explained that Jupiter and Neptune have a very strong effect on gold prices. And people think this is a little bit odd, but remember the seasonal cycle is nothing more than calendar dates, and the calendar is calculated by the relative position of the Earth and the Sun. So that's a solar cycle. So here we're just using a Jupiter-Neptune cycle, which is about 13 years long. So they're 60 degrees apart in late July. This pair has an effect on inflation hedges, especially gold. And below, we're going to see the effect on the gold price from 1969 projected into this August. All 7 prior such angles have had a bearish effect. There are 60 and 300 degree sextiles. They're both classified as sextiles. It doesn't matter. They both have the same effect. This is a 300 degree sextile, and we'll go down one. I presented this last time. Remember that, Larry, in late July?
Yes, sir. I remember it very vividly, yes.
Look at the projection of the cycle and look at the high day in gold.
Yep, I remember it. In fact, everybody in the den remembers it. So go ahead, Bill.
And right now, you're in, and now let's move over to Elliott wave analysis. That appears to be A down, B up, and we appear to be in a C wave. And we're not that far from the low. So I wouldn't be surprised if this became an irregular C. It did not get to a new, in other words, it did not get below that August low. These waves and indicators we read in books, they very rarely turn out to be textbook examples. There's usually some degree of variation. So it may have already bottomed, but I would just give it one more week. And then you're back. Now let's take this cycle and do exactly what we did 1 month ago. Let's expand it. You'll see this in the next slide.
Okay, now this is the, I think we got that one up here. This is gold 2, correct?
That's it.
Okay.
And now I expanded it a bit. Now you can see that drop that I just showed. We expanded. Now we expand the graph, and note that it goes up after that. And it's done this all 7 out of 7 times. So now we've got the situation we had 1 month ago reversed. So we have this cycle, which is static. We have the sun through the signs, which is the calendar or seasonal. You saw that September is very strong. That is static. And we just looked at the dynamic monthly cycle. The only thing that's not in gear here is the weekly cycle, but the weekly is not strong enough to overpower this, in my opinion. So a gold low is either formed or is occurring at the end of the month. So let me see if we go down one more. That is the gold monthly cycle, but this time I've expanded it because you might be wondering why I'm calling for a high up in November, December. It's due to this cycle. And by the way, there have been the biggest drops have occurred in the month of December. If you break them down by days of, I think, 5% drops. And anyway, the end of the year is usually an inflection point. It's leading into the weaker part of the year. January would look very bullish. I think you have to pay some bills.
Yeah, we got it. We have that's correct. We'll be back with Bill Meridian in 4 minutes, folks. 877-927-6648.
Larry Pesavento watches the markets 24/7, and now is a great time to try out his daily trading service, Fibonacci 24/7. Larry publishes videos and charts for subscribers throughout the week when warranted, and every weekend he puts out a thorough report covering worldwide markets, futures, commodities, and currencies with Fibonacci retracement levels, possible trading setups and zones, and stops and targets for all recommendations included. Larry applies the principles he's developed over decades of trading while analyzing a variety of markets for subscribers. To see for yourself the types of videos, charts, and analysis that Larry provides for his subscribers, sign up for Fibonacci 24/7 today by visiting the front page of TFNN.com under the newsletter tab. You'll also gain instant access to Larry's archived subscriber webinar from earlier this year. New subscribers get a 30-day money-back guarantee, so you have nothing to risk. Sign up today. If you're a trader in the market looking to find the path that leads to maximizing profits while decreasing risk, then now is a great time to try out Dave White's daily trading service, The Path of Least Resistance. Through the use of options and equity trades, Dave advises his subscribers on a daily basis of the current market conditions and what possible trade setups are on the horizon. The Path of Least Resistance is published every trading morning, often with updates intraday when initiating trades or closing out positions. Dave White has advised his clients of some outstanding winning options and equity trades in recent months, and now is a great time to try it out for yourself. New subscribers to the Path of Least Resistance receive a 30-day money-back guarantee. See for yourself the types of options and equity trades that are available by signing up for the Path of Least Resistance today by visiting the front page of TFNN.com and selecting the newsletter tab. Sign up today. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartleys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, Bill Meridian with Cycle Research is our guest today, folks, and we're talking about gold. And you're looking for a price level around $22.50 this year, Bill?
Yeah, that just comes from plain vanilla technical analysis, looking at the last formation gold broke out of and projecting it up. So that's a fuzzy number. I think it's a minimum. I think it might even go higher. And here you see, if you look at that last graph, the dynamic cycle weakens just at a time when the static cycles, in other words, the average gold price for the year, tends to soften or turn down. So we'll probably see a correction in Q1.
Okay.
Yeah, and you go, oh, I see. You're one slide ahead of me here. The gold.
Yeah, what I did was,
gold
I
breakout to
my,
2250. Yes.
yeah, I broke.
Now
Went a
you'll
little too
notice
fast.
it did almost a precise 50% correction when it ran up, and then it bottomed in 2015-16.
Okay. Bill, I have a question myself.
Yes.
Hopefully, is there? We have some people talking about 3,200, 3,500 gold. That could easily happen since we've taken
Oh,
out
sure.
that 1,900 level. And if Bitcoin can take off, I mean, I guess gold can go too. So anyway, but there is a possibility that we could double it from 1,900.
Oh, yeah.
Okay, just double checking.
Well, let's just keep in mind that if this is I'm not sure if this is a wave, but commodity waves on the upside tend to subdivide or extend more than do stock prices because they're driven purely by emotion. So 2250 to me is a minimum. And
Okay.
these guys they keep issuing credit or printing money like crazy, and without much benefit to the economy, except of course if you're a speculator and you can guess where that money is going to go. And I don't see the economic system getting much better, and I don't think all the economists of the world are suddenly going to throw up their hands and admit they were wrong and swear allegiance to the Austrian School of Economics, and they're going to deflate the money supply. In fact, I have a friend he's now head of the House of Commons in England, and he said, yes, Bill, he said, I've never seen any politician campaign on a platform of deflation. So They are unlikely to come to their senses, and we can keep buying baseball cards, sneakers, posters, antique cars, etc.
I'm just blown away. A pair of sneakers for $500,000. Wow. That.
Well, remember the banana the banana taped to the wall for 120,000.
Whatever happened to that? Do you know? Did somebody actually buy it?
A guy bought it, and then with all the cameras on him, he ate the banana. It was considered a piece of art, so he bought it as a joke and ate it. He had $120,000 to throw away.
Shut the front door and raise the rent. Oh my gosh!
Yes.
Go ahead.
Yes. Okay.
Go ahead. We start on the stock market now.
Yeah, the next month is bearish for the S&P, and as we all know, September is the weakest month of the year. Why? Nobody knows. And I read the Financial Analyst Journal, which is the heavy-duty PhDs. I have read it since graduate school, and they analyze this and they dance all around it. They analyze it and they tell you it's statistically valid. We have no idea why it occurs, and they leave it at that. They don't like to think about it too much because they can't explain it in terms of fundamentals. But anyway, from 1885 to the present, September, all months, 48.5% of those months have been up. September in years ending in 0, which this is, 38.5%. September in election years up 42.4% of the time. September in both 0 and election years up 16.6% of the time. Now, of course, the sample size gets smaller as we progress, but look what's happening to the bullish percentage. It's dropping. Okay. So let's go now down one more slide.
Okay.
In September, the cycles point down. As I just pointed out, September in 0 and election years has been up in only 1 of 6 cases for a loss of 3%. The weekly and monthly S&P cycles decline. Those are the dynamic cycles that I showed you earlier. And the 1-4-10-year cycle also declines in September. So let's go down one more. Now, the 1-year cycle, as we know, is just a seasonal cycle. That's the red line. The market tends to bottom in the spring, rally into the summer. It tends to correct in the fall. Q4 is strong. In fact, Q4 has generated 60% of all S&P profits. Now, the blue line is the 4-year cycle, which I'm sure a lot of people know. It's been calculated pretty precisely to be about 3.83 years, I think. And that is attributed to the Federal Reserve wanting to make the president at that time look good, so they juice up the money supply to get the market moving up. The only problem with that argument is that this phenomena existed before the establishment of the Federal Reserve in 1913, and in countries where there's a 4-year election cycle, a 6-year election cycle, or no elections whatsoever. In other words, there's a 4-year cycle. And the green line is years ending in 0. That's the decennial pattern, or the 10-year cycle. So if we go down one more, that is the addition of the top three, or the three cycles, the 1, 4, and the 10. And you will notice a decline in September. So that's our projected for this year. I have it in 2016. I was ranked number 1 in timing by Timer Digest, relying solely on this cycle because it was very accurate. And I have not relied on it that much in 17, 18, 19, or this year. This time I'm relying on it because if we go down one more to the monthly, now here you see a blow up of the monthly cycle that you saw in one of the earlier slides. And you'll note how the market just tends to flatten out for about the first 2 to 3 weeks of September. I put the little arrow there.
Yeah.
So that's the monthly cycle. So if you go down one more, Larry, here's the weekly cycle.
Which are we on 20?
We're now on 19.
19. Okay, let me get that up here. You got that marked as a weekly, and I thought I heard monthly, so hopefully I get this right. There we go.
We looked at the monthly cycle on slide 18. Now we're on slide 19, which is the weekly cycle. So
18.
There we go. And you see the weekly cycle points down. And so if we go down now, are there signs of this? Is it starting? It should start to manifest. If you go down one more slide, this is the equally weighted S&P 500. In other words, each cycle, it's like the value line index. Each cycle, each stock is weighted equally. There's no capitalization weighting. And if you look, you'll note it has not hit a new high. And look at the red line is the momentum line. You'll notice that the momentum line has not made a new high, and the green line is the relative strength versus the regular S&P 500, which is capitalization weighted. So this is telling us what we all know, and it's been in the media for the last month or so, that it's the gang of big tech stocks are leading this market higher, and without much participation from the average stock. This has made stock picking much more difficult, because most stocks are simply not going anywhere. Some of them are declining, some of them are going sideways. So I think this is a sign. Okay, we're going to pay some bills and we'll come back and look at sentiment.
I think you're right. We'll come back and look at sentiment. We'll be right back, folks.
The gold market has taken off topside in a large way in 2020. If you want to take advantage of this sector, now is the time to subscribe to my gold report. The gold report took profits in 4 of its equities in the gold portfolio in the first week of January for a combined profit of 99.2%, with 2 positions left in the portfolio that have a profit of 67.5% as of January 7th. The gold report is a comprehensive look at the metals sector as well as the markets that move gold, which is the currency and bond markets. New subscribers get a 30-day money-back guarantee, so you have nothing to lose. Every Monday morning, I publish a gold report with coverage of gold, silver, bonds, the XAU, HUI, GDX, as well as more than 30 different mining equities. To see for yourself the types of profitable trades that are recommended within the gold report, sign up now by visiting TFNN.com. Don't miss out on the next great gold trade. Sign up today.
Will the S&P 500 continue to climb? For bold trades on U.S. large-cap stocks in either direction, trade SPXL, SPUU, or SPXS. Directions Daily S&P 500 Bull and Bear Leveraged ETFs. Direction Leveraged ETFs. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den. The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of the TFNN shows, plus see all of the charts as they happen live and have access to archives of all of those charts. You can test drive the Tiger's Den absolutely free for 30 days and greatly enrich your knowledge of these markets and how to make your money work for you. Details on the Tiger's Den are on the front page of TFNN.com.
TFNN has launched our brand new website. You can still visit us at the same TFNN.com URL, but when you do, you'll see a new and improved homepage with a much simpler navigation, whether you're watching Tiger TV live in high definition or just accessing your newsletter subscriptions. We even have new pricing in 6 months and yearly options. Check out the new TFNN.com now and experience all the upgrades. TFNN.com, educating investors.
The Bull Bear Trading Hour with Tom and Tommy O'Brien. Next.
Okay, we're back, folks. We're talking with Bill Meridian, Cycles Research, and we're on market sentiment. Is that correct, Bill?
Yes. Here's another measure. Or here is another barometer suggesting we have some sort of a high coming in. The latest survey of active investment managers from the NAAIM shows that the average manager is 97% exposed to stocks. Even the most bearish manager is net long. Now, Larry, when you had me on in March, this number was about 30% or 20%.
Yep.
So the professional fund managers are not exactly a very good measure. So we can apply contrary opinion. So even though stocks hit records again this week, the percentage of bulls remains low. This is the AAII poll. The number of bulls, it's crept up, I think, from 20% to about 30%. But you have to remember that's a poll. That's not actually people risking money. And the demographics show that this is mostly older people in our age range who tend to be, except for Larry and I, more conservative, and therefore they don't risk their money that easily. But the poll of newsletter writers by Investors Intelligence is showing very high optimism. And there's an odd spread between the AAII poll and the newsletter writers who aren't risking any money either, just their reputations. But smart money hedgers have reduced their net long to about $24 billion. That's about half of what it was in May, but it's still above prior extremes. So, in other words, the smart money is cutting back as September approaches. And what I'm not showing here, I showed it to you last time, is the smallest option traders are heavily, heavily net long. I think it was at a 20-year high. And so when you go through all these different measures of sentiment, I come up with a reason to be somewhat cautious over the near term.
Okay, makes good sense. I have a question, Bill,
Sure.
that you could probably answer from because I know you used to be, I think you wrote for Barron's or still does, but the Apple made the first page on, or the headlines on Barron's this week. So does that make any sense that?
Yes, because September is the weakest month to hold Apple.
It is. Okay. Well, that's
yes,
interesting.
it is.
To know. Yeah. Huh. Okay. Well, we want to go to the bonds now.
Well, the bonds, August, I'll just review for people who didn't hear me a month ago. August has been the strongest month to hold bonds. The monthly cycle pointed up. So bonds were up about 74% of the time in the month of August. And those numbers are the highest of any of the 12 months. And then I pointed out that the momentum from July, because July had been up, if July is up, bonds are up in August, 19 of 22 cases. Let's look at the seasonality. And there you see the run from June, July, August, almost mirroring that, but not quite mirroring that of bonds. And then if we look at, that's bonds 2, let's go down to bonds 3. And there you see the cycle gave a buy, and this cycle is right 70% of the time, and I guess we hit the 30. So I calculated roughly that the odds of bonds closing the month of August higher were about 80%. It looks like we hit the 20. And I remember I used to quote percentages like this when I was at Payne Webber in New York. And, if I said there's an 80%, 70% chance of something going higher or lower, and it didn't work out, they would call up and you said, but there was an 80, 70% chance. I said, yeah, we hit the 20 to 30. And they said, what? And I said, we hit the 20 to 30. And they said, what? And they just couldn't get it. So, but if you apply this methodology over a number of markets, that it makes money over time, or it has for me. So let's go down and look at the current. Just keep in mind here that September is a weak month for bonds. You can see that in the bonds 2 slide on 23. You'll just note September is not strongly up or down. Then if we go back to to graph 24, we'll note that the dynamic cycle points down. And so let's now look at a technical picture. So it looks to me like right now, and by the way, bonds tend to move in terms of time units, 3, 5, and 8. So it moved down here. I think it was 1, 2, 3, 4, 5 days, and then it bottomed, and it is now running back up. So my current outlook is that bonds are probably going to run up into the first day of September, but not be able to break through that 140, 145 level, which is now resistance overhead. So I think you may have seen an A wave down. This may be a B wave up, and we may be facing a C wave down in September. And the third week of September is one of those bearish months of the year to hold bonds. This happens March, June, September. I don't know why that is. And we can't ask the professors either because they don't know.
Okay. They're tied with everybody else, that's for sure. Bill, we have a question for one of our listeners. Yes. Are you on the camp that we are going to go to negative interest rates here in the United States?
I think that might happen because I remember when it happened, and you will remember this, Larry, Switzerland in the 70s. People were so frightened of currency collapse, they felt that the Swiss franc was the best currency to hold. So Switzerland actually got the advantage of charging you to hold your money. In other words, you got a negative rate. They were charging you to hold your own money. And I don't see the governments. I mentioned this before, but I was in Abu Dhabi talking to a group about 5 or 6 years ago, and I was pointing out the key is these increases globally in money supply. And I said they do this to finance government deficits, and this whole process of people spending money, who politicians who understand very little about economics, spending money, and the central banks then issuing credit to sop up all that debt. I said, this will end when camels learn to fly. And my audience said that they fully expected to see a sky filled with camels before they saw that. So
I like that.
And I go all the way back to Professor Robert Cavish's class, NYU, 1970 or 71. It had to be 71. Nixon signed the Smithsonian Agreement cutting the link between the dollar and gold. Yeah. And people raise their hands as a professor, what will this mean? And he says, well, there'll be a lot more money available. And my other professor, Levine, said this is permanent institutionalized inflation. And Cavish said, this means that when we have booms, they'll go farther than they should go if interest rates remain reasonable. But when you have declines, they're going to be very, very sharp and very sudden. And my observation is they're over a lot sooner. And I've told this story before, but back in 87, the stock market crashed when I lived in New York. I called up my old friend Art Merrill, author of Behavior of Prices on Wall Street. And I said, Art, you've been doing this longer than I have. In determining a bear market, what's more important, price or time? He said, well, if I had to choose between the two, I would say price. And so we both agreed that 1987 crash was a mini bear market. And so in one day, most of it was over, October 19th, 1987. And so I was telling everybody at Payne Weber, you should be buying because for this reason. So
will you come back? This is our last commercial. We'll be right back with Bill Meridian Cycles Research, folks.
Back in the day, I joined Hotel California in 2006, and like many of you, was drawn in by, as well as...
Whatever you think about, you bring about. Whatever you focus on grows.
You see, I believe that everything in life happens for us, not to us. And Tom ignited the fire within me to want to learn how to master the markets. So how did I go from knowing nothing about technical analysis to becoming the #1 market timer for the S&P 500 in 2018 and the #2 market timer in 2019? Simply put, I hired coaches with a proven track record, which led me to a whole new set of tools that I created to interpret the message of buyers and sellers. I would love the opportunity to teach you this award-winning set of tools and to help you improve your market timing. You can test drive my newsletter service, Mastering Probabilities, for the next 30 days with no risk to you. Plus, you'll gain access to archive workshops that'll take you step-by-step through my system. Sign up today by going to the homepage of TFNN.com and selecting Mastering Probability in the newsletter tab.
If you haven't checked out the newsletters page of TFNN.com, what are you waiting for? All of the TFNN newsletters are informative, up-to-date, affordable, and a must-have for every trader looking to gain a competitive informational edge in today's markets. TFNN newsletters cover every aspect of the markets to offer you the very latest in market news. Plus, new subscribers get to test drive our newsletters risk-free for 30 days. From all aspects of the markets, including stocks, bonds, metals, commodities, and tech, there's a newsletter to fit your needs exclusively from TFNN. Stay informed each day you trade and get that competitive edge that will help you stay ahead of the game. Visit our newsletters page by going to TFNN.com and click the newsletters button near the top of the page. TFNN.com, educating investors.
With markets trading with extreme volatility and peaks and troughs everywhere, regardless of what you're looking at in the markets, this is a great time to see the type of analysis Basil Chapman delivers for his subscribers every market day with the Opening Call newsletter. Basil has been analyzing markets, providing his take for subscribers to his trading services since 1984. Every morning, Basil publishes an update for his subscribers, along with weekend and evening updates when warranted. The Opening Call provides traders a daily market overview with regard to the direction of the key indices, selective stocks, and commodities, along with specific recommendations, including stops and targets. You also gain instant access to Basil's subscriber webinar archive from earlier this year, a dark cloud cover, and essential market analysis. Ride the Chapman wave today by signing up for the Opening Call newsletter on the front page of TFNN.com under the newsletter tab. New subscribers get a 30-day money-back guarantee, so you have nothing to risk. Sign up today.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, folks, we're back with Bill Meridian, Cycles Research. Bill, we have one question, and then you can give your where you can get their stuff. The U.S. dollar, what's your opinion here?
Well, right now you're in the most bearish time of the year. And if you look at the sentiment numbers, the sentiment is very, very pessimistic. However, that has not buoyed or lifted the dollar in the past. Right here, I think you may be looking at a rally. Where is it, up or down this morning? I haven't looked because I haven't.
It's up a tiny bit. I mean, it's not much. It's not doing very much.
Yeah, that's exactly what I think is happening. Yeah. I think this is probably a wave 4 up. I'm trying to get a chart on the screen because it has hit, as I remember, as soon as I see it on the DXY. Yes. The cycle here has bottomed. It's turning up, but I think you could rally up to 94, and that's going to be it. It'll turn down again. Because maybe next time, if you looked at the seasonality, those histograms I have month by month, right now you're right in the midst of the single most bearish time of the year. The sentiment, as I said, is very negative, but that has not lifted. There's been no reversion to the mean. It has not lifted the dollar in the past. So I think you're looking at least, on the downside, probably 90 before it turns up again. And that's, of course, that is a propellant for gold.
Okay, that sounds great. Okay. Listen, you want to give a little commercial before we have to leave?
I publish Cycles Research Early Warning Service, which is monthly with interim messages in between as needed. And I also have my favorite subject, astrology, at BillMeridian.com. I have astrology books. And, of course, under my regular name, Bill Cerubi, I do publish at Forbes. I've given you, I think Larry gave you the links earlier. And, that's it for now.
Okay, listen, you'll come back again, hopefully, one of these days?
Sure.
Hey, thank you, Bill. I really appreciate it. And be safe, and God bless, and we really appreciate you being here. Bill Meridian, Cycles Research, folks.